Our guest today is Christopher Perkins, President and Managing Partner at CoinFund. Today, we're talking about the stablecoin infrastructure era, what it actually takes for digital dollars to become the plumbing of global finance, why security is the biggest risk most people are underestimating, and what TradFi's entry into the space really means for builders and investors. Before we get started, a quick disclaimer. The opinions expressed here are those of the host and the guests and do not represent the views of their employers or affiliated organizations. This conversation is for educational purposes only and should not be taken as legal, financial, or investment advice. And with that, Christopher, welcome to the show, sir.
Hey, thanks for having me, Luther and Rami. Good to see you guys.
Absolutely. Before we get started, thanks so much for your service from the bottom of our hearts.
Just wanted to extend my wishes and say, and hoping Rami, you and Darren Abu Dhabi, all the best to you and your family. I hope everyone stays safe.
No, very kind. Thank you, man. Thank you. Much appreciated.
Chris, I think you and Rami crossed paths back in the city world. Would love to get your journey from city managing trillions in flows to the wonderful world of digital assets that we've all come to love and use today.
Yeah, got my start as a U.S. Marine, and I was in the Battle of Ramadi 2004, which is a pretty difficult urban combat. My unit faced a number of different casualties in KIA. It gave me an incredible appreciation of risk management, and really armed me with a really, I think, a special perspective about life. Transitioned there, and I went to Lehman Brothers. And like Bitcoin, that emerged as a phoenix out of the global financial crisis. I mean, I was in the depths. I was in the trading desk at Lehman Brothers when we went down. I was running a derivatives book, about $100 billion in notional. And I gained a real appreciation for how markets work, how market structure works, how insolvencies work, and really, really understood the flaws of the existing system. Got a call from Citigroup the next day. They asked me if I wanted a job. I said, yeah. They're like, what kind of package do you have? They said it was a great package. It's a job. Talked to my wife who was in mortgages and pregnant. And she's like, dude, get down there and start. And I took the C train down and showed up. It was mayhem. And wouldn't you know it, all of my trades were gone because I was at Lehman. So I was the other side of the trade. So I had to hedge that book back out, my own trades. It was so weird. And then Dodd-Frank was passed and the regulators, went crazy. And they really thought, gosh, this derivative stuff's out of control. We need to regulate it. And in the US, we had Dodd-Frank, but even before that, it was an issue for the G20 itself. They're like, the global financial markets are intertwined. We really need to have common standards. And maybe we're even seeing some of this interconnectedness with the Strait of Hormuz right now, just how connected global markets are. And so we ended up passing this global derivatives reform. In the US, it was known as Dodd-Frank, where we had to take the $700 trillion derivatives industry from unregulated over to regulated. You'll start seeing how this is starting to rhyme with crypto. I stepped up and led the clearing business. So we had to start clearing these swaps. And it was really interesting because at the time we didn't have technology. The only way we could solve this is by increasing centralization, increasing intermediaries. And what we did was we regulated the hell out of the central clearing counterparty. So we centralized all derivatives, we put all this collateral in it, and then we just stared and watched them to make sure they didn't get out of control. And so the solution at the time was extreme centralization. We didn't have decentralization as an option because Bitcoin was just getting born, right? Ended up running two other businesses at Citigroup. I took over our foreign exchange prime brokerage business. After there was a big crisis, the board parachuted me in. And there I learned an appreciation for the FX markets, which we're going to talk about today. These are $7.5 trillion a day markets. They're actually largely unregulated when you start understanding those markets, and they're pretty decentralized. In fact, no government really wanted someone to regulate its currency. Somebody else really. So the market came up with a code of ethics, if you will, the FX code, right? So they try to keep norms, knitting market. Again, that rhymed a little bit with crypto. And then last job I had was I ran a global futures business. So I had about 725 direct and indirect reports, electronic invoice execution and clearing. So I was running those three businesses. I'd gotten into crypto years prior. Actually sat next to a lady named Sandy Call, who a lot of people know from Franklin Templeton. She's a futurist, and we used to start talking through just how big a deal this technology was. And, in the beginning was like all about settlements. Like, wow, I'm like sitting in the middle of these, like literally billions of dollars of collateral flow for my businesses. And I'd be scared to death because if those flows were coming in from Japan, I'd have to settle out one side. I'd have to wait for the yen to come in. And I was an intermediary. So I was taking all this, what we call Herstat risk, which is like settlement risk on collateral. And I didn't like it. And I'm like, wow, I can just start settling this stuff. It's going to be insane. So try to get it off the ground at the bank. The bank wasn't ready. And we're talking, this is like 2014, something like that. Like they just weren't ready. And then eventually, I just got so obsessed. I just walked out the door. And I joined Coin Fund. I've been the president there for about 4.5 years. One of the managing partners. We have seed, venture, and liquid strategies. And so really I've had a chance to really immerse myself in this entire industry. I serve as a member of the Global Markets Advisory Committee for the CFTC, and I'm on the Digital Asset Market Subcommittee. And last thing is we've announced that we're going to be spinning out of Coin Fund. So I'm very excited to make some big announcements here in the coming days.
Wow. What a journey. No, it's fantastic to listen. And yeah, I remember certainly from being at Citibank, from the FX prime brokerage time before you joined in, I sort of remember that previous life. And certainly for me, settlement was a problem because we were actually sort of dealing with effectively margin brokers and hedge funds who needed to, how do you get a margin call over on a weekend? You can't. If there's a problem on a Friday, there was I think, Japanese flash crash or something in 2010 or 2011, and suddenly you've got all these people on margin call, can't do anything with it. So certainly that was one of the things that attracted me to stablecoins, a 24/7 settlement instrument that can move, outside banking hours. That was a game changer for me, and agreed with Herstat risk, FX on chain. Why can't this happen? So really
There's a couple things that you mentioned that really we should talk about. The first is just the amount of capital that's trapped in the system right now. And the reason it's trapped is because when you have this settlement latency, right, you have to hold collateral against it. And so, for example, in the $500 trillion swaps market, we require a minimum of a 5-day margin. Or if it's not cleared, we require 10 days of margin. Why? Because you have to plan for the fact that this stuff isn't settling. So you have to hold a lot of extra collateral. And that is just a big liquidity drain on the entire system because that collateral just sits there, right? And so one of the other great unlocks that we haven't achieved yet across markets is the liberation of collateral. Because if you could settle things instantly, why do you have to hold 10 days of risk? Now, maybe there's some underlying liquidity issues in the underlying portfolio you're trying to hedge, but you're going to be collateralized that much faster. So it's not a panacea, but it does unlock capital. And then I think, Rami, it's important to mention, you mentioned Herstat risk. I mentioned it just for the listeners, what that means. In 1974, there was a bank. It was called Herstat. And they had an issue because they had some liabilities due, and they had some receivables coming in, and they couldn't pay the liabilities fast enough because the receivables were delayed. That settlement risk led to their insolvency, which really kicked off a lot of the Basel rules and everything else. But because you have that quote settlement risk, it's now deemed Herstat risk for the people that like you and me that think that we're smart. Like, yeah, Herstat risk sounds smart, but it's just settlement risk.
True. It's just settlement risk. But what you mentioned though before is actually really important. So what you're saying is through the technology innovations that are coming in now, the risk component is decoupled from the infrastructure and technological constraints of the system. So, now a risk manager can say, yeah, I do want 2 days margin because of the risk, not because the system takes 8 days and, we need 2 days. I've got 10 days risk and that's how much capital. That's the difference now, which, technology allows us to actually price risk accordingly and ask for the relevant collateral for risk accordingly. I think that's a major innovation.
100%. Think of it differently. It's like a tax because of your ineptitude.
Yo, just give me 1 second. I'm setting up my tabs real quick because I had to restart my computer. So give me just 1 second.
Yeah, no problem, bro. Take your time.
I'm just letting these dudes talk it out real quick while I just orchestrate everything.
To settle on a timely basis,
Yeah,
right?
exactly.
Like
Yeah,
it's a crappy infrastructure tax. You guys,
yeah,
you're going to take 3 or 4 days to settle your yen because it's a long weekend. Well,
yeah,
tough. You're going to have to hold collateral. That's your tax. And my
yeah.
point is that that capital right now is trapped. It's just sitting there. It's not productive. It's helping nobody. Like, and we'll talk about interest, I'm sure. Like maybe you're making a couple of basis points of interest, but like some intermediary is taking it all anyway. So it's just a waste.
It's crazy how,
Agreed.
this concept of stuck collateral. So my background is predominantly from a payments perspective, Chris, and this shows up everywhere, right? So in the world of remittances, this is basically called pre-funding, right? So every
Yep.
remittance company out there has to hold pre-funds because of the fact that you couldn't trust the other party that they would ultimately settle, and even if you did, you didn't want to hold the bag for $30 million on a Monday. When you woke up on a Monday for everything that you settled, and in your case, it's trillions, but it's slightly smaller, but the concept is exactly the same. And it's crazy how it's something that is a result of poor plumbing ultimately this whole time. But that being
Yep.
said, so on-chain effects, right? Like we've talked about this on the show before. I would have really thought that on-chain effects would have been at a 10x where we are right now, and there would be a plethora of non-US stable coins out there to kind of set this whole on-chain effects rolling at the speed we expect it to be. What are your thoughts on why we're not there yet?
Yeah. I mean, I've had the same thesis for a long time. And it's important that you continually challenge your own theses and be like,
Hmm.
why hasn't this happened? Like, it seems so obvious to me. And one of the first things that I learned when I moved crypto full time is that I have to unlearn a lot of things. And the fact is that for a number of different reasons, we are just not seeing the demand for FX, non-US dollar
Yeah,
stablecoins.
yeah,
I think in many cases, it's because governments got their policies wrong.
Hmm.
yeah,
I think MiCA was a challenged regulation. It's very hard to run a profitable euro stablecoin
yeah.
company, particularly with some of the capital rules that make you reserve in a low yielding environment. So, like, I think some of it was their own doing, but I think
Did the volume of that video sound better when I turned it up a bit, Aqua?
Yeah, yeah, definitely.
All right, sweet. Alrighty, everybody, what is going on? Welcome back to another Wealth 28 Club Friday podcast. In today's video breakdown, we're going to do a two-part series. Off camera and prior to this call, Aqua had thrown a very interesting vocabulary word that he had mentioned that he read in a Fed report that just dropped recently. I believe you mentioned it was on April 7th.
Yep.
And that word that you had said to me that stood out was the word opportunity, right? Opportunity. And so the first portion of today's video breakdown, I want to really fixate your attention on that key vocabulary word and just show you guys what some of the largest institutions in the space are discussing and talking about on panel discussions and in their upcoming summits that are taking place, and just things that have been verbalized from systemically important organizations that the mainstream media will never share with you guys. And then in the second portion, because that'll open the door for Aqua to kind of share what he read from the Fed that recently dropped on April 7th. The second portion of today's video breakdown, I want to dive thoroughly through two reports, one in which discusses the foundation of institutionalization that was put out February 2026 from Ripple and Quinlan and Associates. Some very interesting statistics to read about Hong Kong institutional adoption that I want to share with you guys. And then I also have this document here from March 2026 that talks about the asymmetric opportunity on Canton, and then just play some video clips that pertain to both of these documents. And then that'll be it for today. So, some really juicy stuff for you guys. As always, if you enjoy these podcasts with myself and Aqua, do us that favor, smash that thumbs up button, subscribe to the platform. We do appreciate the love and the support. If you're on Twitter, reshare this podcast so that way we can have some more lovely individuals join us this Friday. With that being said, I want to start off here with this one. Watcher Guru posted this out, and I really don't pay attention to Watcher Guru's posts, but it definitely it clicked for me because I remembered what somebody from Hidden Road said just a couple of months ago. And it says Japan officially approves the bill to recognize cryptocurrency as a new financial asset, right? And I remember what Michael Higgins from Hidden Road, now obviously, of course, rebranded to Ripple Prime, said about how we are at an inflection point for digital assets as the largest financial institutions increase their demand and exposure to invest in this space. And so this announcement from Japan and what Michael Higgins here from Hidden Road had said in a previous panel discussion just again screams that word opportunity that Aqua is going to share with you guys here in a second. So listen to what Michael Higgins here says.
And do so in conjunction with the governments and the global regulators. And so at Hidden Road, we've been pretty consistent with this from the start that we think crypto is the 7th liquid investable asset class. It's encouraging. There's lots of folks now referring to it in the same way. Investors, retail and institutional, all have their money invested in 6 asset classes: equities, credit, rates, commodities, real estate, and cash. And crypto is definitely the 7th. And if that is happening, then its trading and investment mechanics will migrate towards best practices trailblazed by the other asset classes. And so this will include best practices in financial transparency, clearing kits, and do so in conjunction with the governments and the global regulators. And so at Hidden Road, we've been pretty consistent with this from the start that we think crypto is the 7th.
Right. And so that was Michael Higgins, excuse me, from Hidden Road. And that was from a couple of months ago. Now, fast forward to more recent times, and we can see this announcement from Japan. They also agree, right, that they're now passing and approving a bill to recognize cryptocurrency as a financial asset, which just goes to show that what Michael Higgins was saying months ago is now fully materializing and coming into fruition. As we all know, that regulation tends to lag in this space. Coming over here, Sandy Call, mine and Aqua's most favorite, I'd say, that person out there on the internet with such crazy credentials that's always constantly dropping gems. She posted this on her LinkedIn profile just the other day. Aqua, of course, you're welcome to give any feedback that you want, brother, after I play these video clips. But she said here in this post on her LinkedIn profile, mind you, again, Sandy Call, for anybody who's listening that doesn't know her credentials, she is an active member at the CFTC, the World Economic Forum, the DTCC, and Franklin Templeton. So I'd say that what she says is pretty important, and she's not just some random person that gives opinions. Crypto is going to be around for a very long time. It's not just hype. TradFi coming into crypto is going to make crypto better. And just again, she was asked this question of 2 key takeaways that she wants to deliver to the audience. Listen to hear what she says.
This is not financial advice.
I also like how at the beginning she kind of smirks with the dude from Ondo and says, "This is not financial advice," when you know for a fact they're like, they know what they're saying.
Well, first most definitely.
What were you going to say, Agua?
I was going to say most definitely, bro. I seen that same grin on her face too. Excitement
100%.
behind that grin.
Straight up grinning like she knows what's good,
Yeah.
Well, first and foremost, is this financial advice?
This is not financial advice.
This is not financial advice.
Next question. Name one overhyped and underhyped crypto narrative.
Ooh.
Overhyped crypto narrative. Crypto is dead.
Oh, good answer.
Every time there's a market pullback, crypto is dead. This is the end of it. Never happens. Crypto is going to be around long after any of us are. Underhyped. TradFi coming into crypto is going to make crypto better.
Spicy. Very spicy.
Yeah, overhyped. I struggle with that one because I think fundamentally crypto is still very much underhyped.
Yeah.
Like it's just it doesn't, the true innovation that it represents, people have not appreciated at all just yet.
What's your take on that, bro?
Bro, she pretty much said that this technology is here to stay. Like in 10 years from now, we're not going to hear about like blockchain never making it, or like whatever happened to that blockchain technology. Nah, this technology is taking over and it's here to stay, and it's going to be here long after us, just like she said.
Mind blowing, right?
Yeah.
I mean, if you really think about it, they're building the financial system for the future, not for the now, So I agree with what she said 100% wholeheartedly, that You know, these crypto assets are going to be what AI agents and artificial intelligence and people that are traveling through space and to and from Mars are going to be utilizing as payments way after a lot of us are, you know, alive. So consider that.
You said traveling to Mars and shit.
Yeah, bro. I mean, if you listen to what Elon Musk has talked about, like he's talked about it so many times, they're not bringing fiat cash to freaking Mars when they go and populate and civilize Mars. You know, they go freaking start a population on Mars. They're not bringing the old fiat system. You know,
They're about to bring that digital gold, bro.
yeah, you know. So I mean, it's just evolution. It's a simple evolution, and because it takes obviously, of course, a little bit longer than most people expected, considering the hype around crypto. Sometimes when the market's pumping, and then these drastic pullbacks are obviously, of course, a psychological, you know, freaking battle. Don't get me wrong, but you guys just heard from somebody that literally said that crypto's not dead. You have these pullbacks, and every single time people think that the market's dead, it's going away, and then boom, it doesn't happen. And the people that lock in, the people that focus, that pay attention to investing in the right projects, the ones that are building now, the ones that are going to be compliant with regulations and have regulations baked in, those are the ones, the projects that are going to come out on top in this next super cycle that we're going to enter into. And yeah, I couldn't scream this video again. Just every video that I'm going to play goes along with that key vocabulary for the first portion of today's video, which is opportunity in all caps with some like 5 or 6 exclamation points at the end of it. Right. This is the BitGo managing director, Jake O, and head of ecosystem. For those of you all who, again, don't know, BitGo received approval from the OCC to convert its South Dakota Trust Company into BitGo Bank and Trust National Association. So they're now a federally chartered national trust bank, right? So you got a bank sitting on stage here telling you guys this stuff. And he just pretty much confirms this event, by the way, look at the date, is from March 30th to April 2nd. So less than, 10 days ago, right? This event took place. No mainstream media coverage. If you go look at this video that was shared inside our private CyberX Discord, it's got like 30 views. It's 30 views. And listen to what this dude here is saying about DeFi. Aqua, I want your take on this one.
DeFi is absolutely a different thing now. So DeFi went from that casino that it was to actually being something material and sustainable in a way that was no longer just pure risk, black box, delegation of assets into a smart contract and expecting ridiculous yield and being able to loop that 10 times over. We are now at the point where large institutions are adopting this, are backing this, are providing fiat and or stable coins into these lending and borrowing protocols to help meet the demand for liquidity. And I do think this is, like, unfortunately or fortunately, one of the sexiest things happening in crypto right now, and one of the highest signal opportunities in crypto right now. And that's because holders are here, hodlers are here, institutions are here holding these assets. Institutions are very, very greedy. The first step that happens after these guys decide that they're going to allocate a position into digital assets is they come to us and they start asking, well, how do I earn yield on this? How do I hedge this? How do I manage this position in a way that makes it more than just a asset on a balance sheet? And the right way to do that is programmable finance. And this is the narrative of DeFi and vaults in general right now. And even vaults in general, or vaults historically have not had the best. DeFi is absolutely.
Bro, what is this guy's credentials? I think I missed that. What?
He's the managing director and head of ecosystem growth at BitGo.
Dang, bro. That's him saying what he just said then is absolutely massive. And it goes hand in hand with our message for the past 2 years now. We've been screaming this. And for him to confirm it as well right now, amongst others, is just, DeFi is here to stay. And these institutions want to play on these protocols to earn yield, period.
They're not going to come into this space and hold crypto on their balance sheet and have it not be earning any revenue for their business models, period.
Yeah, they're not getting these digital assets to put them in a cold storage wallet and just let it sit there in a vault doing nothing.
And hope that they perform well.
Yeah.
No
these
way.
guys implementing cash flow strategies, sophisticated strategies, that what's so amazing is that the average Joe can learn this stuff as well, but people still choose to look the other way. And, it's yeah, bro. It's
As
exciting.
a matter of fact, most of these institutions that come into crypto, whereas retail is going to be managing their portfolio, at least for the time being, physically themselves, most of these institutions are already in the process and the works of building out, systematic freaking AI agents or algorithms that are going to balance their DeFi portfolios for them automatically on the shift of sentiment, on different risk appetite exposures, different freaking, like if the Federal Reserve comes out and hikes rates, the freaking AI agent's going to automatically shift and allocate capital outside of its crypto exposure and into stable coins and balance and rebalance every quarter and all that stuff. And it's going to be all automated. So, if you're not learning this stuff now, like Aqua just said, to get ahead of the curve, it's going to be quite confusing at first, just like any new endeavor is. But now is the time to start incorporating digital skills and start learning things like DeFi and how to take your assets, or not maybe take your assets out of cold storage, because I don't personally recommend that right now, considering the unregulated landscape still exists. But, using DeFi with test amounts and playing around with test money and learning about these things and jumping on protocols and, testing out how to connect wallets and how to prompt AI properly. So that way, how to speak to AI in order to get it to do properly what you want it to do. Like, all of that is a process, and anybody that takes advantage of it now in the early days is going to be an absolute, at least at an intermediate to more advanced level when everything kicks off and it's fully implemented and we can all really truly profit from this stuff, rather than being a beginner after the institutions come in. You don't want to be a beginner in this space after the institutional money has come in. You want to be a beginner now, testing the waters, learning about these things, educating yourself before the institutional capital comes flowing in, because that is where, again, all caps, that key word today, the opportunity lies, right?
Yeah. And these vaults have caps. So same with the liquidity pool. So, they can get filled up real quick. And if you weren't paying attention, you have to, possibly get put on a waiting list to even have an opportunity to have access to that vault. I don't know exactly how it's going to work, but I mean, that's one of the perks to understanding this stuff now and paying attention now. So
this gentleman here, I got a couple more video clips, and then I'll end it here, Aqua, so that you can share screen. This is what I want to share. It's this stablecoin tokenization and how credit unions can seize a competitive advantage event that's coming up next week, April 16th. And now these next two shares that I'm going to give you guys actually have the word opportunity in them. And then that'll open the door for you to read that message from the Fed from April 7th. But this gentleman right here, John Kiko, Senior Director of Investments at Hashgraph. So, we have a Hedera representative here in line with everything that's happening so far. Personally, I mean, obviously, of course, not financial advice. I'm personally bullish on Hedera Hashgraph long term, what they're contributing and doing in this space. But it says here, institutional players aren't asking whether they should or should not apply this technology. They are asking where it gets applied. And this gentleman here from Hashgraph specifically mentions this is an opportunity. So let's just listen to what he says here.
Products. It's also for the institutions that are issuing this, could be a real meaningful sort of revenue source. So if the reserves grow in value, so does the yields associated with that. And so that becomes a net new sort of source of income or cash flow into the company. And that can be then, direct.
What did Aqua just say to you guys a second ago? Income generating, cash flow
to the company.
Just two dudes. We're just two dudes on the internet, just
yeah, literally, bro.
Just two dudes on the internet saying everything that all these large, sophisticated entities are saying. There's a reason for that, guys and gals.
Man,
word for word, that was good. All right, let's continue.
Into if you're, let's say, a retailer, you can, or some sort of, somebody that provides goods and services, they could redirect those funds into loyalty rewards, or perhaps airdropping some of those stable coins into their customer wallets, and really providing that sort of tailored experience for their customers. And so, I think the challenge there is like, okay, well, what wallet infrastructure do we use, and how do we apply it? And so those are the questions now. I think it's not about whether we should or should not. It's about where does this get applied? How much of this cannibalizes our current versus not? Is this an opportunity? And so those are the conversations we're having today. And where Hedera provides value is the underlying technology. And so we're a decentralized ledger technology. I mentioned at the beginning of this call that this podcast that we provide a public network as well as a private network. So some of these larger institutions may want to use their own private network to manage the mint burn, and really tracking their customer information and having sovereignty over their data, and not have to sort of be vendor locked. They have full sort of control over their network, and then freely interoperate and distribute that to either Hedera mainnet or to any other network they choose. And so if they believe that the future customers that they want to attract is residing in a different network, they can do so. And if they want to find liquidity in these stable coins outside of their own sort of environment, they could do so with the ability to interoperate stable coins across others. And so it's becoming far more easier to do so and find real market fit in this environment. And now it's just really kind of working on the last mile of how do we implement this. And just the one last sort of note on Hedera, what's really unique about our sort of ledger technology is that every single transaction in terms of validating and costs or gas fees is fixed price, and it's very, very low cost. So if somebody on the finance team is looking at how much does it cost to run this program, they can really project out based on their sort of expectations of how much volume they're expecting. They could really manage expenses that way. And also as Olivia mentioned, finality is absolutely key. So being under 3 seconds, deterministic finality for when assets move from one wallet to another or one account to another, that it is final, and they're not waiting multiple minutes to ensure that there is a probabilistic determination whether that is actually in that person's account or not. And so those are really important features.
One thing that I really like that this guy said that I feel like a lot of people on social media don't pay too much attention to, because there's a lot of tribalism that exists. But haven't you noticed that all these executives and all these managing directors and all these people that work for these entities and these layer ones, they all scream interoperability. And this dude even just mentioned, like, he didn't shill Hedera. He just said what Hedera is capable of, but also said that if these institutions want to use Hedera, but then also want to use other chains, they can integrate Hedera's technology and be interoperable with other chains as well, which I just think screams very loudly of not only Hedera's position, because they're not tribal, but that people listening need to realize, like, it's not about to be a one chain rule them all ecosystem, and you should be focused on chains, networks, that have interoperability features baked in, because if not, then the chain's not going to survive. So I just really like that highlight right there, that he didn't really shill Hedera. He was just like, yeah, we have these features, but at the same time, these institutions might not want to use Hedera. And if that's the case, then we can interoperate with other protocols and do things in a interoperable fashion, which is great to hear.
I mean, Marshall even said it as well, too. We shared his talk track a few weeks ago. He had said interoperability and compliance baked into chain is key. So
I actually, as a matter of fact, think I posted something on my Twitter when you said something about KYC or compliance baked in. Let me find it real quick. I know I responded to something that you said, because I have found I don't remember who it was. JP Morgan. Was it JP Morgan or Morgan Stanley? It's a lady from either one of those. And she had said something about KYC being absolutely mandatory in the future. If these institutions are going to use these networks, like, they're going to have here it is right here. I know I did. Hold on. Yeah, you did. See, I know I got timestamps for everything. You said interoperability and compliance baked into the chain are key. right here. And then I replied back to this and I said, yeah, KYC is key. Emma Landrelot, hopefully I'm pronouncing her name correctly, the executive director of JPM Coin. Institutions won't touch it unless compliance is baked in.
I think it's not just like lacking new entrants, but when we think about a lot of RWAs, like they're not bearer instruments like stables or even like other digital assets are. They are, papered funds, right? So there's like a KYC side to this ecosystem where there's papering, to get into the investment, or, these off-chain KYC assurances to bring parties to the ecosystem. And it's similar on the cash side, right? JPM Coin is a permissioned asset. We issue it for our clients, but on public chain. And I think that once you put those assets in the ecosystem, in order to actually build a buy side and a sell side, you need a lot of common clients. So I also think it's like the distribution aspect will continue to grow, but you need to start to kind of bring parties who have the discovery and the right distribution to know, like, how do I know Theo's on my approved list, right? Like, so that those types of constraints also exist, but they're critical because if institutions come to the space, and I'm sure we'll talk more about this, but KYC assurance will be key, right? Because they want the risk management of being comfortable of like, what asset are they holding? Who are they holding it with from a custodian perspective? Who are they interfacing with? Where's the trace of funds coming from?
It makes you think about all these protocols and everything in the space that still exists without KYC right now, screaming institutional adoption, when, come on now, these institutions ain't touching it. And if it's not KYC compliant or BSA compliant or all these other compliant features that these institutions have to adhere to.
Yeah. It's like, what is your guys' plans? I mean, you guys haven't set it on your roadmap, or made any announcements on this topic, but people like ourselves that are tapped into this, we're questioning that. Like, how are you guys going to become compliant? Like right now, I can go onto your protocol and I don't have to KYC. So how do you guys align yourself to get KYC implemented once compliance and regulations here? I mean, Clarity Act can be passed in at any moment, or it can get pushed to later years. But I mean, I feel like we're on the cusp, and it's like, if that ends up passing, I'm curious to see how some of these guys move.
I got this last post, and then after you're done sharing something about the Fed, I want to take you guys back to what this dude here said about Kraken getting access to the Fed in 12 to 24 months. So I'll play this after Aqua shares his piece. But coming back over here, the last take that I have on just highlighting that key word today for the sake of the first portion of today's call, which was opportunity. We have Credit Union 40 Group posting this 2 days ago on their LinkedIn profile, and it says, join Jed Meyer, CCE, Justin Burleson, David Pierce, and John Ungerland as they cover digital assets, stablecoins, and tokenization, which are reshaping financial services, and find out how credit unions have a rare opportunity to seize a competitive advantage in this quickly evolving market. And so just take out that word credit unions for a second and replace it with retail investors. It's the same thing, right?
Yeah,
we have a rare opportunity to seize a competitive advantage in this quickly evolving market. And this is one of those events that gets shared in our private CyberX Discord. I signed up for it. I'll be attending this webinar, right? Sitting alongside, I'll probably be one of the only retail investors that's sitting alongside credit unions listening into this event to learn how, core capabilities and fintechs are racing to replicate stablecoin functionalities, secure digital asset safekeeping, lending against tokenized assets. So there's DeFi right there. Exchanging access, deposit products, and new interchange-driven revenue opportunities. Look at that. Revenue opportunities right there.
Yeah. Especially the DeFi part too. They didn't have to. Yeah, this FedNow article goes hand in hand with this as well. Do you want me to share it right now?
Yeah, 100%, bro. Pull that up real quick. Add it to the stage.
All right, let's see here. So yeah, FedNow, this article titled Instant Payments is in Focus, an inside look at the FedNow service. And I highlighted a couple of areas. I'll just read through it here real quick. The first highlighted area says, today, nearly 1,700 financial institutions participate on the service. FedNow service growth has accelerated steadily since launch. And new tools and innovations are broadening the range of popular instant payment use cases. Now, out of that 1,700 financial institutions, I will mention there are some credit unions on this list that are in the Metallicus Banking Innovation Program. And let's not forget that Metallicus is a service provider on the flip side to that list for the FedNow. And they're the only ones that have 4 check marks. So for those of you that are like, why are we reading the FedNow article, right? That's to, kind of give you some peace of mind. But let me continue to read here because it gets really, really bullish. So this next highlight area, I said, on the business side, use cases such as instant B2B vendor payments and corporate treasury fund movements are gaining real traction, especially now that our higher $10 million transaction limit supports more complex, high-value flows. Insurance disbursements are another area of positive momentum. Instead of mailing checks, carriers are paying providers and policyholders instantly, which reduces administrative friction and dramatically improves the customer experience. And this next part is quoted, "For consumers, earned wage access and gig worker payouts continue to stand out. People are increasingly expected to be paid instantly at the end of their shift, and institutions are leveraging the FedNow service to meet that expectation." Keep in mind, XPR Network can run payroll services on this caliber. So just throwing that out there, but let me continue to read. It says, "We're also seeing more financial institutions enable account-to-account transfers that let customers move money instantly between their bank and brokerage accounts, which helps them proactively manage their investments. With instant payments through the FedNow service, credit unions and banks can disperse auto loans instantly, right? DeFi, including on nights and weekends, ensuring auto dealerships get paid in seconds, no matter the time of day, and the buyers can drive off the lot without delays. Real estate is another exciting area. Instant payments enable closings to be finalized after hours or on weekends without being constrained by wire cutoff times." This next part is another quote from this guy from FedNow. He says, "When I talk to the financial institutions, the pain points I hear are very real, whether it's settlement and delays, cutoff times, weekend and holiday blackouts, or customer frustrations about not having immediate access to their funds. The FedNow service is designed to eliminate those friction points at their sources." And it continues, he says, additionally, with the speed, finality, and data-rich ISO 222 messaging built into our service, we're helping financial institutions reduce errors, streamline exception handling, and meet rapidly rising expectations for immediacy. These capabilities go far beyond simply moving money faster. They improve the experience for consumers and businesses alike, from payroll timing to urgent disbursements, alleviating long-standing operational burdens while delivering the modern, instantaneous experience customers now expect. And this is the highlight that goes hand in hand that Cypress was pointing out. It says here, what's ahead isn't just about incremental upgrades. It's about ongoing modernization of how money moves in this country. And we'll keep collaborating with the industry, learning, leaning in, and leading where it's appropriate for us to do so. This is an incredibly exciting time to be in payments. The pace of change is rapid, the opportunities are real, and financial institutions of all sizes have a chance to shape the next chapter. My message to the banks and credit unions is simple: seize the moment and join us in this transformative journey. And that's the end of it.
And when was the date of this? April 7th, right?
Yeah, a couple days ago.
Nuts, bro. You ask the average individual that's walking out there on the streets right now what the Fed just said about digital payments and the change of the financial system. They're going to be like, who the heck is the Federal Reserve?
Yeah. Yeah.
So the fact that just anybody listening into this just knows now what the Fed just said about this instant payments and how it's in focus.
I got one other share too to put the cherry on top of this, and this is shout out to I forget, it might have been Rhino. I think he had posted this screenshot, and I'm not too sure. It sounds like he has a bank account over at SoFi Bank, which is basically an online bank, right? And they're on the list of participants for the FedNow service, right? But peep this. Let me share this with you guys. This is just last. And this is just proof that it's coming, right? So hold on. Let me see here. Oh, wait a second. Because it's I might have to share my entire screen right now. Hold on.
While you're figuring that out, Paul, why don't you post it on your Twitter real quick, bro, or something so you can pull it up?
Yeah, that's a great idea. Hold on. Yeah, give me a moment. Yeah, let me do that, and then I'll come back.
While you're doing that, I'm going to share this video of this dude here real quick from the Future of Finance Summit that took place in 2026 from just a month ago from the Bretton Woods Committee. Let me just give you guys this dude's credentials. He's William C. Dudley, Chair, Bretton Woods Committee, former president and CEO of the Federal Reserve Bank of New York, right? So not just some random dude. And we remember here what he says about Kraken gaining access to the Fed in the next 12 to 24 months, which is just huge that a crypto exchange is going to have this type of access. Listen to what he says here.
Role to play in this as well? In other words, what kind of access is the Federal Reserve going to give to the new digital finance players? Just over the last couple of days, Kraken, which is a cryptocurrency company, was given access to the Fed, master account to the Fed. So that means that they can settle in central bank money. That's sort of the gold standard. I think I'd like to see the Fed go farther in this direction, because at the end of the day, cash at the Fed is the safest asset you can hold. There's no liquidity risk. There's no settlement risk. There's no default risk. Farther in this direction, because at the end of the day, cash at the Fed is the safest asset you can hold. There's no liquidity risk. There's no settlement risk. There's no default risk. So having digital finance companies that can actually settle at the Fed, I think, is actually the best case. Now, you can't go to that instantaneously because you don't have the regulatory regime in place to basically put the rules for the digital finance industry on the same plane as what exists for commercial banks. So we're sort of in the process now of going through the conceptual phase to the implementation phase. And, that's going to play out over the next, I'd say, 18, 24 months. And then we'll sort of see what the true rules of the road are at the regulatory level. And then I think once
Did y'all hear that? We are in that implementation phase over the next 12 to 24 months where we're about to see this. And think about it. Like, why the heck would they be giving a crypto exchange access to central bank money if, like, I can't even explain how much liquidity is about to come into crypto? It's so crazy. That is nuts.
Yeah. Trillions, bro. Trillions.
Is this what you wanted to bring up right here?
Oh, yeah. Let's let me share this real quick here. Where's my screen at? Let me see if I can blow this up. All right, can you see it pretty good?
Yeah.
All right, so this was an update to somebody who banks over at SoFi. And it says here, we've made some updates to the SoFi Bank deposit account agreement, blah, 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 blah. But the main highlight right here, and it's dated April 8th, yesterday, or 2 days ago, 2026. It says here, we're rolling out the ability for SoFi checking and savings members to send instant transfers via the FedNow service to eligible and external institutions. These transfers are available 24 hours a day, 7 days a week, 365 days a year. You'll receive a notification as soon as this is available to you. So we about to go live. That's what that sounds like.
Yeah, man, I'm telling you. And it just goes hand in hand with these summits and these things that are taking place. I got 2 more video clips to share with you guys to kick off the remaining portions of today's call. But this 40 group stablecoin tokenization CU summit or not summit webinar that's taking shape. If you want to attend summits like this, all of this stuff, everything that we've posted so far is all available inside the private CyberX Discord in the research section. But I signed up for this, and it says right here, look at this. St. Cloud's Financial Credit Union will share how it surpassed acquiring 12.6 Bitcoin, representing more than $800,000 held on behalf of its members through its credit union digital asset vault, a core integrated hybrid custody model with Deland's LLC C2C or coin to coin, I believe, Midas platform. Their experience proves that members want to explore digital assets without having to leave institutions that they trust. And this is everything that they're going to go over. So, this is just such a crazy opportunity to be alive right now in this space and just take advantage of learning all this stuff, listening to these panel discussions, and just seeing what's happening in the digital transformation. Last but not least, these two clips right here. This is, I forget this lady's name. Hold on, let me look her up real quick. Samara Cohen. Sorry, not her name. I just forget her status. Hold on. She is the Senior Managing Director and Global Head of Market Development for BlackRock, right? And she was sitting on this panel discussion, which, look at this. This is crazy to me. The algorithms, I don't know if you guys listening in have realized this, but the algorithms are like, they're suppressing this information. They're suppressing, they're keeping this information on the wraps. This has 67 views. You would think that a lady, a representative with her stature sitting, actually, as a matter of fact, I'm pretty sure in 2025, she won the most important woman in all of finance award. Like, she's like one of the most important ladies in finance in 2025. She won that award. And listen to what she says here. They talk about how more GDP will flow into public blockchains. And then she hits the time horizon outlook with the 6 to 12 month outlook. So I'm going to play two clips back to back.
Better outcomes from.
And I mean, like, my thesis on all this stuff is tokens and equity. It's all just converging into one. And in 5 years, we won't say, oh, there's tokens and then there's equity. It's all just one thing. And I think the thesis is also that more and more capital every single year will just flow onto public blockchains. And I don't know what those blockchains will be, but I think if you look at what Visa is doing, who just presented, and what Stripe is doing, they're just more GDP will come onto public blockchains.
Yeah, I think that's right. I think more of GDP will come onto public blockchains. And so the question is the pace at which that happens and where the demand comes from. I think in the US and Europe, investors.
That's it. That's all that needs to be said. You have the freaking global managing director at BlackRock saying that she believes that more GDP will come on the public blockchains.
Yeah. Tokenization of real world assets.
Like, in a bear market, in a pullback, you would have never heard this back in 2020, 2021. BlackRock wouldn't be sending electors on stage saying this stuff publicly.
Yeah.
Which is crazy to see. All right, next here is where she goes on to give that time horizon, 12 to 24 months. Or she says 6 to 12 months, my bad.
Interesting that, these are two very distinct paths, and we will see them play out in parallel.
Yeah. When you look out at the next several months, do things feel, so we had Genius, but even like Clarity and just global market structure, are you able to predict what the next 6 to 12 months looks like? Or do you feel like now is at this moment in time where everything's up in the air?
I can't predict what's going to happen after the next 6 to 12 months, but I think it's pretty clear that over the next 6 to 12 months, and you guys have seen evidence of this discussed over the last 24 hours, we are going to see a number of new models of tokenized securities and of payments coming online in the United States. So the big question that will be answered as they come online is, how do they work together? Particularly, should we have like a stressed market event? Are there dislocations? Are there things that really undermine on a broad basis participation in the markets? Or what are the things that investors actually find the most useful? And I thought there was a session earlier with Austin around the importance of the utility of public blockchains. And I think something that will be really important over the next 6 to 12 months is how the models that have open standards self-improve to create interoperability, to enforce price alignment, and to aggregate liquidity. And how that plays out will define what things look like after that 12-month period. But I think it's going to be a pretty period of aggressive and important learning as these things come online in markets.
Yeah. Are there any important
aggressive and important learning?
She had the option too to say it's up in the air. We don't really know, and she decided to give her prediction.
6 to 12 months, everything coming online. I mean, you know, it's getting closer and closer to the point where we can continue to try to deny it and prolong it and push these dates out, this and that. But eventually, you know, these institutions will feel comfortable with regulations in place to flood in at scale, that is a scale that we have never seen before in the 17 years of crypto's history. You know, we've never seen an institutional utility cycle ever. I mean, 4 trillion, we hit what, $4.24 trillion in market cap. There's organizations out there that process that monthly, you know. I mean, there's probably organizations out there that process that daily.
Yeah, no doubt.
So very early days. Aqua, I had a couple more things to share, but we've already been going on for about an hour now, man. So I mean, I don't know if you wanted to roll that over, or if you wanted to cut it there, but this was a great call, great clips, great engagement from everybody in the comments there. So maybe we cut it there and let everybody enjoy their weekend.
Yeah, I don't mind whatever you want to do. If you have any more bullish stuff to share, I'm always down to watch it. And my daughter's calm right now, so I got a little bit of time if you want to run it.
X Vision said 30 more minutes. All right, we'll run a couple more minutes then. All right, I'll go over into my spiel, reading these two documents real fast from Ripple and the one that goes into detail on the opportunity that exists in Canton. So first particular video breakdown here is, again, coming back to the Future of Finance Forum. And now I want to really get your attention on this whole, it's not going to be one chain to rule them all kind of ideology. So kicking it off with that, of course, and listening to what this dude from the Monetary Authority of Singapore says here to just confirm that thesis, right? So listen to what he says.
So-called the network layer, MES introduced a program called Global Layer 1, where, like, to Bill's point, we don't believe that there's going to be one kind of like network, one winner, if you will. There will be several, right? Those of you in the international policy sphere will know, yeah, there are quite a few very large, if you will, initiatives going on to bring, you know, multiple stakeholders together, and we think that's a good thing, right? Ultimately, if the financial system wins, where, you know, there's one, perhaps more, right, such large networks in place, but there should be some degree of interoperability. There should be some degree of commonality when it comes to issues of, you know, uptime, whether it's uptime, right, as what Greg mentioned, or also in terms of regulatory compliance as well. How can the institutions that transact on these different networks gain at least a common degree of, you know, understanding and clarity that these transactions are actually meeting regulatory obligations? So these are the issues that we think about. And finally, as I shared earlier, at the settlement layer, right? So we have products, we have networks, and then we have settlement. At the settlement layer, we also want to have multiple streams, right, to advance discussions on what it means to actually have effective settlement. And the central bank, so-called CBDC side, I shared earlier.
So we'll play it there, right? We'll leave it there. He talks about interoperability. He talks about multiple networks. He talks about regulatory compliance. And again, this is just not some random dude. He is a dude from the Monetary Authority of Singapore. So take into consideration what he's saying. Rolling over here, and just let's go over some statistics to get the brain juices flowing, considering that we are in a massive pullback, hinting and going off of what we said at the very beginning of today's call, that word opportunity. This is a document from Ripple and Quinlan and Associates. Hopefully I'm pronouncing that correctly. I'm just going to read some highlights, institutional highlights, mind you. The foundation of institutionalization and digital asset custody landscape in Hong Kong. The executive summary reads here: while digital assets have long operated in an unregulated or regulatory gray area, recent years have seen financial regulators across the globe introduce clear frameworks, safeguards, and legal standards to bring digital assets under former regulatory oversight. Sorry, the font is so small. Opening the door for a greater institutional adoption. In fact, 77% of financial institutions that they surveyed in Hong Kong have either already adopted digital assets or actively plan to do so. So I highlighted that for you guys, and going back to the first portion of today's video, where we've had these timelines where the dude from the Bretton Woods Committee, the ex-Fed chair, or the ex-Fed representative from, I don't remember what Fed position he held, but he said 8 to 24 months, and then the lady from BlackRock said 6 to 12 months. Well, let's look at the documents here as well. So down here, it talks about how digital assets ranging from tokenized real-world assets to cryptocurrencies are increasingly being perceived as attractive investment vehicles, driving greater institutional participation in the market. In Hong Kong, financial institutions have already begun incorporating digital assets into their operations, with 77% either already having adopted them or actively planning to do so. This reflects the growing recognition of their strategic importance for both sell-side and buy-side financial participants. Among Hong Kong's financial institutions, tokenized traditional financial assets, fiat referenced stablecoins, and crypto ETFs stand out as generating particular interest, particularly due to their ease of adoption. Collectively, these trends signal a deliberate shift in institutional behavior in Hong Kong as digital assets transition from niche experiments to mainstream components of investment strategies. And then right here in this graph is what I want to take your attention to. And it says that in the next 1 year, or in the next 0 to 12 months, that 32% of the institutions that were surveyed for this survey plan to adopt crypto. And over the next 2 to 3 years, so that fits into the 18 to 24 month category, 20% of institutions plan to adopt. And then right here, it talks about the percentage and the interest of what asset class they plan to allocate to. And crypto actually comes in the third spot. So you can see tokenized financial assets come in at 68%, crypto ETFs and digital money come in at 65% in second place, and cryptocurrencies like Bitcoin, ETH, and XRP come in at 58%. So really great to just see those types of timelines. There were some other interesting highlights, but again, I just wanted to give you guys a perspective, from an institutional standpoint via these institutions that were surveyed in this report. So that was good to read. Coming over here to this report from March 2026 titled The Tokenization Megatrend. And it's titled Why Canton is the Best Way to Play the Biggest Structural Shift in Financial Markets Since the Internet. So here it mentions the opportunity. And then I want to play 2 video clips off the back of this intro and the opportunity here. It says, there is a lot of opportunity in the crypto market, but only if you know how to navigate it. The honest truth is that 99% of the crypto market is noise. Meme coins, copycat projects, and tokens with no real-world utility dominate the headlines and drain retail capital. But buried inside that noise is the 1%, a small handful of networks and protocols that are being adopted by the largest financial institutions on the planet. These are the investments that will define this cycle and the next decade of capital markets. And so, in collaboration with that statement from this document, I want you guys to listen to Alex Cutler, who is the primary co-founder and key developer of Aerodrome Finance, who is the leading decentralized exchange on the base layer 2 chain. So listen to what he says here about what he thinks the future is going to look like in crypto.
Pretty firm belief that a lot of this kind of fundamental based investing is returning back to the space. Yep. As you look around, there's more suits here than there are at pretty much just about any conference over the last couple of years. These people want to invest in value. How do you think about this? How do you think about creating value from the Aerodrome perspective? What is the Aerodrome kind of investment thesis here?
Yeah, I mean, I think we're in a transformative moment, right? And if you saw that at the policy conference, you saw it with the guidance that we just got out of the major regulators. We see it at the cusp, perhaps, of getting clarity. We are moving, I think, from a time where the investment game was, will this shitcoin pump? Will this token with absolutely no fundamentals, will it be able to get in early enough and get out fast enough to make some money? To a moment where people are actually going to be looking at, and we're going to have a new class of investors looking at, can I own the best infrastructure of this space? What can I own that's going to accrue value as the space grows by an order of magnitude? What are those mechanisms? What does the token do? What rights does it grant me? And I think as that maturing and new investor class comes in, that's going to cause a massive reshuffling of what's seen as investable assets versus not, because 90% of the top 100 tokens right now by market cap don't redistribute any value whatsoever. Do you really think all the funds, all the suits, walking around us today are going to come on chain and buy a token that's a functional meme coin? No, I think we're going to see a massive reshuffling in the top 100. And I think it's going to be oriented around, how do I own a piece of the most valuable infrastructure of the on-chain economy?
Bro, we've been saying there's going to be a massive reshuffle with the top cryptos right now, bro. And for to hear this guy say it is like, yo.
And he's not only talking about a massive reshuffling, but he specifically said, you know, owning a piece of the infrastructure that actually generates revenue, that actually generates you value, right? Holding a token that actually brings value to the token holder is of key importance. DeFi opportunities, lending, borrowing, even just the tokenomics themselves leading to, burn of the token, right? So that it becomes a deflationary asset, not an inflationary asset. I mean, there's a whole new economic backdrop that goes into investing now that institutions are about to flood in. But he's not the only one that shares this perspective, that collaborates with this document, right? So this is another event that took place, Liquidity 2026, from just 3 weeks ago. Look at the views again. I'm telling you guys, they got this stuff suppressed. 45 views on this video. Shout out to the CyberX researchers in the Discord for this one, and dropping all these gems, right? But listen to what this guy here says.
Is its proper utility. And look, the market structure bill has the concept of a mature blockchain, capital M, capital B. So if you're the SEC, are you going to give authorization for a company to issue a tokenized financial instrument on a brand new L1? Like, I think the answer is candidly no. And so what we're going to see, I think, a convergence around some of the very well established and heavily understood and broadly accepted L1s, and we're going to see I think we'll see a sort of real selection process go on. So I would imagine that we see a lot of L1s become redundant over the next kind of 5 years.
Yeah.
Like, he pretty much kindly said they're going to be going away. Like,
there's going to be a massive restructuring. It has to happen. And unfortunately, a lot of people's feelings are going to get hurt when it happens. But remember that if you're investing based off of emotional feelings because of something that you've seen on the internet, and instead of doing real deep research and actually paying attention to what the institutions are adopting, you really truly risk messing up this generational opportunity because you're watching the wrong people on the internet, spew all this hype and hopium to you all these years. But in reality, the institutions on the back end behind the scenes weren't really ever adopting those layer ones, and they were over here trickling out with other layer ones. You have to have that discernment from hype and reality.
Facts, bro. Facts. Yeah.
And
I would even say too, like, you shouldn't be all in on one. Like, you shouldn't have all your eggs in one basket in this game right now at all.
That is super big risk.
That's massive risk, bro. Because if that that basket ends up being one of these nobodies, I guess we could say, you're going to be completely out. I feel
there's
like
there's three things that are going to get people completely wrecked this cycle. It's lack of digital literacy. So, like, not understanding DeFi, not understanding tokenization, not understanding artificial intelligence, like just anything digital transformation. Get your digital literacy up. Second thing is proper risk management, right? Make sure that you are not overexposing yourself with leverage. Make sure that if you are testing out DeFi strategies, you are doing it with what you're willing to lose, and you're not overexposing yourself in your portfolio. And then the third thing that's going to get people wrecked is tribalism, is being tribal towards this idea that your chain, because you watched a YouTube video on the internet with some theorist talking about how one asset's going to be worth $10,000 in the future or something, and sticking to that mentality and that mentality only, and not actually seeing what the institutions are saying, the ones with credentials, the ones like the Visas of the world, the freaking MasterCards of the world. And when they make an announcement that they're working with a public layer one, not like doing research on that public layer one instead of the one that you like because it's your personal opinion, that stuff's going to get people wrecked.
Yeah.
This cycle.
Super wrecked. And I'll say this too, if there's any more volatility, which I'm sure there's going to be, right? Not understanding why the markets are down too. Like, if something drastic happens and these markets go even lower, so many people are not going to have a clue as to why, and they're going to think, oh my God, it's really over, you know?
Yeah, if like fundamentals, like having a fundamental understanding of the backdrop and the liquidity cycle that we're currently in, and central bank positioning, monetary policy, freaking, you know, I don't inflation, labor market data, geopolitical risk, all those things, 110%, bro. 110%. Could not agree with you more. All right, last two fundamentals real quick. I just want to share with you guys this specific post just goes on to talk about. I don't want to show you guys Canton, so I wasn't going to read the whole entire thing because this article here, or this post, this report is pretty biased towards Canton. I'm not going to lie, but one thing that he talks about in this post here is it says developers get paid on Canton, not just validators. This is one of the most underappreciated features of Canton. On Ethereum and Solana, when a user pays a transaction fee, 100% of that fee goes to the validators who processes it. The developers who actually built the application, the team that create the product, attract the user, and generated all the activity receive nothing. This broken incentive structure has forced app developers across crypto to create their own tokens just to monetize their work. It is the reason the market is flooded with thousands of tokens that exist not because they need to, but because developers had no other way to capture value from the products that they built. Canton fixes this entirely. If you build an application on Canton that brings activity to the network, the protocol pays you directly. Think of it like a revenue share model. That's a key vocabulary word right there. A revenue share model. The network recognizes that without great apps, there are no users, and without users, there are no fees. So it pays the people who actually drive growth. This creates a powerful flywheel where better apps attract more institutions generate more fees, and more fees flow back to the developers who made it possible. So I'll play this video clip, this last piece right here from this lady. Let me just share her credentials. She is the head of portfolio growth at CoinFund. CoinFund is one of the world's most experienced crypto native investment firms. Her name's Jenna Pilgrim, and she literally says word for word exactly the problem that Canton solves. Listen to what she says here.
So for the first question, maybe let's talk about like what is a narrative and what's driving the narratives. Is it the KOLs? Is it the VCs? Is it just the price? Or is it something else? Go for it, Jenna.
So I think differently from other cycles, we're really seeing revenue and fees drive narrative. And I think that's a lot healthier. It means that those of us who come from traditional finance understand that things can actually be measured. We have some models that we can run on protocols now. And we never used to be able to explain why protocols were able to grow or why developers wanted to build on them. Many people hold the belief that the best technology will win. And I think we've actually seen that to be not true. The best technology won't win. The best distribution will win. And I think that distribution is really incentivized by what revenue and what protocol fees you can pass on to the user. This whole concept of collective ownership, but also collective earning, is a new concept. It seems kind of like silly and novel, but yeah, that's a real narrative driving forward, I think.
So, you know, don't take that for me. This is an institutional investment firm, CoinFund, and she says, you know, we got to wake up out of this mindset that the best tech will win, because that's not true. These institutions are profiteering. These institutions are greedy, and they're definitely not going to come into this space and adopt something if it doesn't generate them revenue and is good for their business model, right? And I mean, that's like kind of like a clear. You would think that people would be like, oh, you know what? Actually, that does make sense. It makes perfectly good sense. If you went into an institution and preached this business idea, or hey, come adopt our layer one, and you had all this tech, like it's super fast, it's compliant, it does this, it settles in 2 seconds, no gas fees, whatever. And then one of the dudes raises their hand and he's like, yeah, but how do we actually profit from it? Like, how do we make money? And then you didn't have anything to say back to the institution when they asked that. They'd probably laugh you out of their office, right? So, you know, we have to really consider that as retail investors when we're doing all these research on these coins and you know, freaking, I don't even know. They come out with some new fast blockchain and they're like, oh my God, crypto institutions are going to adopt this blockchain. It's the fastest one. And you get headstrong on it and you're like, oh my God, it is. It's faster than this. Or it's faster than that layer one. And you get attached to it. You have to ask yourself the question, if I invest into it, outside of price appreciation, how is it going to make me money? How is it going to generate me revenue? Does it have DeFi capabilities? Does it have incentive mechanisms? Does it Did the tokenomics actually lead to a burn of the token, creating a deflationary spiral? All these things, like, those are things heading into this new cycle of institutional adoption that we as retail investors really have to pay attention to. And I just can't stress enough, again, like I mentioned, not being biased, not being tribalistic, and just really having digital literacy and understanding these types of perspectives. So shout out to the CyberX researchers for all these shares. Aquaman, it was a blessing. Everybody in the chat today was very respectful and super motivating. So great to see you guys come out on these Fridays calls with us. But yeah, that's all that I have for you today.
Yeah, bro. I just wanted to just add one thing to this video and the point that she had made. The super validators on Canton Network are the ones that have the access to build on Canton, to receive those fees. So I feel like it's almost safe to say, right, that these super validators are going to be building on Canton Network to take advantage of that, right?
And they have some of the biggest super validators in the freaking world, bro. And I mean, it's crazy how many other announcements have recently come out. Like, this happened just yesterday. PCP partners with Digital Asset and the Canton Foundation. And look at this. It says, Programmable Credit Protocol, PCP, a credit orchestration infrastructure for tokenized assets developed by semi-liquid tech labs, has partnered with Digital Asset and the Canton Foundation to provide the Canton ecosystem with institutional credit infrastructure. The collaboration will see PCP enable custody-native lending against assets on the network, said to allow banks, hedge funds, market makers, and other market participants to borrow and lend against tokenized securities, fund deposits, Canton Coin, Bitcoin, and many others. So, huge announcements left and right. Canton is definitely one of those assets that you don't want to, ignore. I'll play this last clip and then that'll be my spiel here for today. And then I'll let Aqua wrap it up if he has anything else. But I said here in this post that data is the new oil. Canton Network, Bloomberg data, once locked behind institutions, is now being integrated directly on chain through Canton. That means real world financial data can trigger smart contracts instantly. No delays, just seamless execution. You got Jane King, the CEO of Keiko Data, who is a leading provider of cryptocurrency and digital asset market data, speaking at the New York Stock Exchange. And listen here to what she says in this response to the interviewee.
Now, you're working with the Canton Network. So they're, of course, on the cutting edge as well as of tokenization. Where do you see tokenization going?
Tokenization matters if you can then do something with the token. And one of the reasons we are so involved and so passionate about building on the Canton Network.
I'll pause it right there. Did you hear what she said? Tokenization becomes important when you can do something with the token.
Right.
Look at a freaking vision. I love him in chat. Freaking bingo, right? That's you nailed it. Couldn't have said it better.
Is that it is a network that is designed for capital markets and that has a very strong privacy by design elements to the way they thought about the network. Privacy is absolutely critical to enabling capital markets applications. You will not have financial institutions, publicly displaying their financial positions or the types of contracts they are working on with their counterparts. So Canton is a network that is very well suited for capital markets application, and that also applies for data. Capital markets application by design, it's already the case in traditional finance, consume market data feeds in order to monitor contracts, monitor collateral value, to create mark-to-market, to price NAVs. I mean, everything consumes data. Financial, data is a key component of market infrastructure. So we are bringing that to the Canton Network.
Now, another announcement that you've had recently is with Bloomberg, which is well known as a data provider on Wall Street, has been for decades. Explain that relationship.
Absolutely. And this also ties back into our work with Canton. What we have announced with Bloomberg is that Bloomberg is working with Keiko in order to bring their licensed data to their users on the blockchain. What does that mean in practice? It means that an existing client of Bloomberg can decide that they are going to build some financial applications natively on the Canton Network, and that those applications that would consume Bloomberg data outside of the chain could now consume the data directly on chain in order to trigger the disintermediated execution of financial contract in a very seamless manner. So this is very important. Data is, one of the key elements to fuel financial applications, and now it is available natively on Canton.
Okay, data is the new oil, they say. So
And protecting that data as well.
I'll end it there. Data is the new oil. As always, blessings to you guys. Remember that in the CyberX private community, whether it's the Wealth 28 Club, whether it's you're inside the Discord, all throughout the week, we deliver non-mainstream research that you will not see on YouTube and Twitter, right? How many of these video breakdowns today that you guys saw that you see trending on Twitter or YouTube? Probably none of them, right? Real macro and institutional market breakdowns we deliver all throughout the week. We have institutional grade technical insights with our deltas and our dark zones that our institutional scalper delivers to our private community. We have 4 to 6 private Zoom calls all throughout the week. I'm always hosting Zoom calls for the community and the members. Aqua's delivering his DeFi calls throughout the week. There's hundreds upon hundreds of educational documents. We have the largest collection of esoteric, spiritual, and awakening resources inside the private CyberX Discord. We'd love to have you on the team. Many blessings to you guys. As always, be cognizant, be aware out there, and we'll see you guys next Friday. Everybody take it easy.
Much love. Peace, everybody.